This chart tracks the baseline expectation for data center infrastructure. Line A shows semiconductor Capex expected to grow by nearly 100%. However, extending that timeline forward reveals a visual cliff. By 2027, those same growth projections experience a drastic drop, settling at approximately 30%. This discrepancy suggests that the hardware build-out may be approaching a point of diminishing returns. Algorithmic efficiency is advancing at a pace that allows software to achieve more complex outputs while requiring less physical infrastructure. As the ratio of compute power per query continues to fall, the industry faces an impending air pocket, a structural void in demand for the very memory and processing chips that currently drive market valuations. If software optimization continues to outpace the physical completion of these data centers, current semiconductor equity valuations are mispricing a significant volatility event. This structural risk is masked by a broader breakdown in traditional market mechanics. The typical relationships between different asset classes have become increasingly disjointed. To see the extent of this concentration, we can compare the standard S&P 500 against a version of the index that excludes AI and energy stocks. Without those two specific sectors, the S&P 500 is currently delivering negative returns. A recent trading session highlighted this fragility when 428 of the 500 stocks in the index sold off simultaneously, even as the headline index remained relatively stable. This internal weakness contrasts sharply with the Russell 2000 Small Cap Index, which recently reached all-time highs. The market is fragmented, with capital moving in highly localized clusters. With breadth this weak, broad indices have lost their utility as general economic barometers. They are now functioning primarily as trackers for concentrated AI liquidity. The primary drivers of this concentrated spending are hyperscalers like Microsoft and Meta. Their strategy relies on a multi-billion-dollar leveraged build-out of physical data centers. This chart plots the computational cost required for an individual AI query over time. As models become more efficient, the amount of hardware needed to generate a single token is trending downward. This creates a version of Jevons paradox. Historically, when a resource becomes more efficient to use, the total volume of demand for that resource tends to increase rather than decrease. While query volume is indeed skyrocketing, the collapse in token prices means the revenue generated from each individual customer query is actually shrinking for the hyperscalers. Consequently, these companies are committing record capital to hardware infrastructures at the exact moment their primary product is becoming cheaper to operate. The speed of this software evolution is evident in the recent jailbreak of Anthropic's Fable 5 model. By removing the safety governors placed on the system, researchers were able to reveal the model's raw, unfiltered capabilities. These security manipulations provide a glimpse into the next phase of development, recursive self-improvement. By utilizing AI agents, effectively digital employees, to refine algorithmic code, developers are creating systems that can autonomously reduce their own training bottlenecks. This shift is accelerated by open-source systems. Chinese models, such as ZAI's GLM 5.2, are now producing outputs that match or exceed the performance of the most expensive proprietary models. Much of this efficiency stems from a mixture of experts architecture. Instead of running a massive monolithic model for every prompt, the system routes tasks to specialized subnetworks, activating only the specific code needed. By routing intelligence this way, these systems eliminate the need for the massive, centralized raw compute power that hyperscalers are currently building. If enterprise clients can run capable, sovereign, open-source models on their own localized hardware, the demand for centralized, cloud-based memory will likely face a sudden freeze. This rapid optimization of open-source software serves as the mechanical trigger that will stall data center expansion and initiate the semiconductor Capex Air Pocket. The stability of the current AI cycle is also supported by a shift in how the market prices global risk. Recently, the maritime route through the Strait of Hormuz faced a significant geopolitical stress test. Despite heightened friction in this critical trade corridor, prices for crude oil and fertilizer actually moved lower. The expected inflationary rally failed to materialize. This chart shows the correlation between that drop in crude oil futures and a sudden collapse in one-year inflation swaps. This downward break in the swap curve indicates that the market is currently refusing to price in long-term supply chain disruptions or energy shocks. In this specific instance, even high-level geopolitical tension failed to spark a commodity crisis. This suggests that, for the current cycle, cross-asset volatility is being driven more by technology cycles than by energy shocks. This shift in market focus coincides with a change in Federal Reserve strategy. Led by figures like Kevin Warsh, the Fed is utilizing new task forces to prioritize different economic indicators. Instead of relying solely on headline CPI, these task forces are emphasizing the trimmed mean inflation metric. As shown here, the trimmed mean strips out volatile outlier data, like extreme energy spikes, to reveal a much smoother trend line currently stabilizing near 3%. If inflation continues to stabilize according to these trimmed metrics, the Federal Reserve may reduce its focus on active rate management. This would leave technology capital expenditure as a dominant and primary driver of market-wide volatility. The gravity of the AI sector has created a capital rotation that is actively draining liquidity from non-yielding momentum assets. Bitcoin provides a clear example of this shift. This chart shows its price action failing to break above both the 20-day and 200-day moving averages, signaling a technical bear market. Lacking traditional cash flow metrics, Bitcoin's valuation relies heavily on a belief in a future state. In this regard, it functions similarly to space exploration, a moonshot investment driven by long-term sentiment. Currently, both institutional and retail momentum have migrated away from these speculative assets. They are instead chasing the actual earnings and cash flows being generated by the AI sector. Until there is a meaningful pause in the AI equity cycle, alternative assets like Bitcoin will likely continue to face a shortage of liquidity. We are observing a market structure where headline growth is supported by an increasingly narrow base of technology sector liquidity. In this environment, the most critical macro signal is the widening gap between software capability and the physical hardware infrastructure meant to house it. Strategic observation of the major hyperscalers is now essential. Any downward adjustment in their forward Capex guidance over the coming quarter will serve as the primary indicator for a shift in the cycle. Even a minor reduction in planned spending could trigger the Semiconductor air pocket, leading to an immediate surplus of memory and processing inventory. The next significant volatility cycle is unlikely to originate from inflation data. Instead, it will likely be driven by the realization that the AI revolution is becoming efficient enough to require far less hardware than the market currently anticipates.